Emerging market stocks have risen to a 17-month high. Those gains based on hopes that a U.S. recovery will strengthen demand for exports from the developing world.
But will investors continue to buy in the new year? Joining us now, Nick Chamie, Global Head of Emerging Markets Research at RBC Capital Markets. Nick, welcome to Bloomberg News. Thanks for joining us.
Thanks for having me, guys.
Nick, what's the picture? What's the picture here in 2010? What are we looking at in terms of, as we mentioned in the lead, strengthening demand for exports from the developing world?
Yeah, I think there's plenty of reasons to be optimistic for emerging markets in 2010 and beyond. The long-term story, I think, remains one of strong economic strength. We're looking for growth to continue to remain up near its historical highs through this year and next year. And in fact, the largest of the emerging market countries, Brazil, China, India, will continue to post growth somewhere between 6 and 10% over the long term, over the next 5 to 10 years. So we expect that more money will be headed towards emerging markets in the years to come.
Nick, might I ask, is it just a question of geopolitical concerns that have had investors skittish, those who might be thinking about investing in the emerging markets? Because historically, those markets have been underinvested.
You know what? Emerging markets have come a long way in a short period of time. The markets have deepened, the accessibility by foreign investors has improved substantially, and as time goes by, I think that will continue to be the trend, and more money will find it easier to invest in emerging markets. As that continues, I think larger and larger allocations into emerging markets will only accelerate in the years to come, especially as we came through this most recent crisis in emerging markets, came away from it mostly unscathed, particularly in Latin America and Asia. I think this will only reinforce the long-term inflows into emerging market countries.
But here's my concern, Nick. Emerging markets coming off, as we've been discussing, their best annual advance on record. You're predicting another near double-digit gain in the new year. Does the word bubble concern you at all? And why not, if that is the answer?
Well, I do believe that there is a near-term risk for a correction. There's quite a bit already built into the price as it pertains to the 2010 growth that everybody's looking for in earnings and economic output. But beyond that, I'm looking beyond 2010, even 2011 and 2012. I think the very strong growth and the burgeoning investment opportunities in emerging markets and the very small allocations that international investors have to emerging markets will continue to drive gains in the foreseeable future. And I would use any significant corrections in emerging markets to be adding exposure here.
Okay, so beyond demand for exports, of course, we're seeing continued economic growth here in the U.S. That ISM manufacturing read, for example, just released this morning. What else is going to drive the economies of these emerging markets?
Well, many emerging market countries have very strong domestic demand prospects for the next few years. In particular, we're seeing signs out of Brazil and China and others that credit lending growth out of the banks is very strong. It's at very low levels in terms of household debt to their incomes to GDP. And that process of monetization in these economies is only beginning. Secondly, employment growth has held up quite well in most emerging market countries, and we expect that those employment gains will continue to drive consumption. Government debt levels are nowhere near the same levels that they are in the G7 countries. Most emerging market countries have debt levels somewhere between 30 and 50% of GDP, whereas you're looking at somewhere between 75 and 100% of GDP. So I think that the long-term prospects for domestic demand growth in emerging markets is, in fact, the driving force here.
And Nick, we should mention last month, even policymakers in Chile voting to keep the benchmark interest rate at 0.5%. How does that factor into your thinking?
Well, we actually expect that the significant rebound in the economies of the emerging markets will actually start to prompt some interest rate hikes beginning this quarter. We think that beginning in Asia, central banks there will start their tightening programs in South Korea, India, eventually in China by March or April of this year. They'll start allowing their currencies to appreciate a bit more and start hiking rates. And then Latin American economies will start to see some rate increases beginning in the second quarter of this year, while Central and Eastern Europe, having been hamstrung by the debt deleveraging, will be more of a second half of the year story.
Nick, we're going to have to leave it there. Nick Chamie, RBC Capital Markets, joining us from Toronto. Nick, thanks.